what's a HEA, or a home equity agreement, or home equity share agreement? You hear called a couple different things. So that is an alternative to a traditional loan. And in a nutshell, the way that it works is um, you contract with a bank. They give you some money out of your property, and then they share. They basically take on an ownership stake essentially in your property. Where, let's just say, for example, and I'm going to pull some numbers out of thin air. Let's just say, for example, they give you $50,000 in cash against your house, right? And then over the next 5 years, your home appreciates in value by $200,000, let's just say. You will have signed a document that says that they are going to share in that home appreciation based on the amount of money that they gave you. So instead of them just giving you a fixed balance, let's say you own a home, it's worth 200,000, and they give you $50,000 out of it. They're going to take a piece, a percentage. What that percentage is, it's going to depend on the agreement, but maybe they take 50% of your equity appreciation from that date forward. Um, if that home goes up in value by $200,000 with this example, they will be entitled to 50% of that appreciation whenever that home sells. Is this a good move or not? That really depends. It could be. It's one of those things where hindsight is 2020. It certainly could pay off if a home does not appreciate in value substantially, or it could be more expensive than just taking out a traditional loan if a home does appreciate in value substantially. I tend to take the approach and the opinion that in most cases, things that are somewhat gimmicky like this, that are outside of the norm, generally will benefit the bank that is offering them more than they will benefit the consumer. Reason being is it sounds too good to be true, right? You can take money out of your house. You don't actually owe a fixed amount. It's going to be variable, and people will package this up and they'll sell it like it's the best thing since sliced bread. Um, Generally, in most cases, things that sound like this are designed to be more beneficial for the institution that offers them than they are to the consumer, just by their very nature, right? That's the job of a bank, is to make money. It's kind of like those temporary buy downs that you see where people say, hey, your interest rate could be 2% lower, and they'll advertise a 4% interest rate, but in the fine print it says, oh, this is just a temporary interest rate. And after the next year, it's actually going to go up. So, it's very important with this type of stuff that you make sure you read all the fine print, you understand exactly what you're getting yourself into. There's no such thing as a free lunch. It's like one of my favorite sayings. It could be great, it could be wildly detrimental to you. So just make sure you read the fine print. Anything that sounds too good to be true typically is.